What are the benefits and differences between exchange-traded funds and mutual funds? Mike in Colorado wants to know. How should Lauren in Florida approach the fixed income portion of her investment portfolio? Would a balanced fund be good for asset allocation in the decumulation phase for DJ in Missouri? Plus, Karen wants to make a one-time roulette investment. Should she hire a broker or do it herself? Join Big Al Spitball on investing from the basics to the alternatives today on Your Money, Your Wealth podcast number 516. We'll kick things off with something for YMYW's legion of old-fashioned drinkers. Today, we're going to find out how you can put your money where your mouth is with our special guest, Jeremy Kasler, the founder and CEO of CaskX, making investing in whiskey and bourbon more accessible and transparent for investors. I'm executive producer Andy Last with the hosts of Your Money, Your Wealth, Joy Anderson CFP and Big Al Clopine CPA. And Jeremy, those watching us on Spotify or on YouTube can see that you've got a wide array of spirits on the shelves behind you. How does somebody go from buying a bottle of their drink of choice to investing in barrels? Walk us through the steps.
Well, yeah, that's a great question. I mean, firstly, most of our investors are whiskey lovers. So, of course, they love the idea of marrying their love of whiskey and, of course, their love of hopefully making money. So, of course, we connect with interested parties. We explain how the process works, the dynamics of investing into something that's tangible, that's real. So we're not selling bottles of whiskey, but we're selling casks of new make whiskey, which, as the name suggests, has just been filled. They just pour the liquid in. And we include 8 years of storage and insurance and taxes within the price as well. So we sit down, we talk to them about why it's a safe bet, if you like. We're not so much focused on the whiskies that they prefer to drink. It's more, we'll recommend the whiskies that we believe have good potential for growth.
Interesting.
Yeah, I see a little bottle of Pappy Van Winkle behind you. So does that have any opportunity for growth?
Well, yeah, price has gone up, tremendously in the bottle market as well. I think a bottle sold for about $50,000 just recently, but that's indicative of the market as a whole. Whiskey is one of the few asset classes that, regardless of market conditions, it will increase in value because as it's poured into the barrel day one, it's moonshine. It's very difficult. You know, if you dropped it on the floor, it would, it would make a hole in the floor. Whereas over time, every day, it's improving flavor. It's getting better and better. So after 4, 6, 8 years, it's very different than it was 8 years previously. So it's a very safe asset in that sense. And you know that if market conditions stay the same or hopefully improve, then the asset will increase in value.
So, Jeremy, how does this work for an investor? Do they buy a barrel? Do they buy a fractional interest in a bunch of barrels, or they buy a bunch of barrels? How does this work? Sure.
So the investor would normally buy a minimum of 24 barrels. Like I say, we manage the investment for that period of 8 years. So it's a very simple process. We, of course, give the advice just as if you were buying a stock or a share. We look at the people behind the whiskey itself. Do we believe that they're good people, going to grow the business, going to create a good product? Just like you buy a stock or a share, you look at the CEO, if you like. And then the investor, of course, makes that decision. Okay, I'd like to invest into this particular bourbon or whiskey. And we then do all the paperwork. Everything goes into the investor's name. It's all very secure, very safe. And we provide the opportunity for the investor to travel to maybe Kentucky or Tennessee, meet the people behind these amazing whiskies, stir the corn, kind of be part of the process.
So what happens at the end of 8 years?
End of 8 years, and it could be sooner, but we include 8 years to give ourselves a good buffer. We look to exit the client, of course. Most bourbons that you'll see on the shelves, they don't actually make the bourbon. Most bourbons actually, or most brands, buy the barrels in and bottle them the next day because they don't want to have to wait 8 years to get paid. There's a huge market out there for good aged bourbon from good distilleries, that there's very little bourbon that gets to past 4 or 6 years old. So when it gets to that age, it's rare, it's desirable, it tastes great, and there's a huge market for it.
I got a question. So let's say I'm Knob Creek or whatever bourbon company that is, with the barrels that you guys are putting together. So are they funding that up front, or they're getting the invest? Explain to me how kind of the genesis of how this stuff works, or are the barrels made and then these big companies buy it and then they put in their special ingredients at the end as they bottle it?
Generally speaking, so for a distillery, there's two types of distilleries. There's those distilleries that make their own whiskey, have the resources to be able to age it for 6, 8, 10 years. Generally, they're the billion-dollar companies as opposed to the less big operators. Then there's contract distillers who exclusively make barrels for other people to put into bottles later down the line. So we deal with a mixture of the two. It's a good way for the distillery to very quickly monetize their work. But when the barrels are sold to the brands, they would generally make a blend. It's not a case of, right, with some, say, scotches where they'll take one barrel and bottle it and release it. So what they're looking for is consistency over a long period of time from the same distillery. And that's where we also come in, because we place orders every quarter. So for a brand that needs consistency over a number of years, they'll buy some from this quarter, some from that quarter, so on and so forth.
Let's say I buy 100 barrels.
Sure. So
and then it's going to age 8 years. And so each year I get a statement, and who marks the price, or how does that work?
Yeah, I mean, the entry level is that it's $2,400 a barrel initially. And like I said, that includes all the storage, insurance and taxes, so on and so forth.
And then can I just take the barrel and bring it home and drink it too?
Yeah, well, I guess so.
I want to wait a couple of years.
I mean, you can make your own brand. You can bottle it yourself and take the bottles back home with you, should you wish. But you'd have to drink a lot of whiskey or have a lot of friends, I would say. Yeah, so we give, of course, regular updates. We give regular valuations. We're looking at the market as a broker. When's the best time to trade a client out? We would suggest, it's not a short-term hold. It's not something you buy today and sell in 6 months or sell in a year. You're not going to make money that way. But certainly we say, look, hold for at least 4 years. If you can hold for 6 years or 8 years, even better. And if you can do that, you'll no doubt see very good returns.
So that barrel that was maybe $2,400, 6 to 8 years down the road, what might be the price, or what have you seen in the past?
Yeah, we've seen historically after around about 4 years that prices will double around there. And if we get into 8 years, you could say somewhere around about the $7,000 to $8,000 mark.
Right. Okay.
So what is the liquidity of the investment? Let's say I buy the barrels and 6 months later, I do need the cash. Is there a lockup period, or how liquid is the investment?
Yeah, so we are governed by the SEC, so it's considered a security. So the rules are very strict. First of all, we can only deal with accredited investors in the first place, and you cannot sell the asset within 1 year. So you have to hold for a minimum of 12 months. Now, after that, of course, you've got the right to sell it. It would be a mistake because you're not going to make any money after 12 months because nobody wants to drink 1-year-old bourbon.
Joe would.
Maybe some of my relatives.
Well, maybe some people do, but no, not around here. They don't. The older it is, generally, the better it is. So if we're looking at a longer hold, in these conditions, we're going to make more money. So I think it's important that we also help the distilleries to present their bourbons in a good way, because all our clients hold it for 8 years. So when someone gets to drink them, they'll all be 8 years old and they'll all be delicious.
Hey, I've got a question. With any investment where there's rewards, there's also risks. And it seems to me one of the risks would be lack of liquidity. So you've got to hold the investment long term. certainly would be what the market would bear at the time of sale. But are there other risks too? Like, do barrels ever go bad,
Yeah,
or are there
rotten barrel.
other kinds of risks?
And what happens if the interest wanes in the whiskey market?
Yeah, no, that's a valid point. And when we first opened, because we're a security, I had to sit down and write 15 pages of risk factors. And he was saying, no, we need more. And I said, I can't think of any more. So I'm pretty good on risk factors. The distillery can blow up. I mean, there's your obvious risk that, it's a volatile substance, and, it's great that it's tangible, but the tangible carries risks as well. We are fully insured, although we're not fully insured at the current values. So we're insured at replacement values, because it would just be too difficult to do that. So if 4 years down the line the distillery blows up, then we'll replace all the barrels and we'll start the 8 years again. In terms of, there can be leakages in barrels, so on and so forth. It's unusual, to be honest, but it can happen. Again, if we see or we find a leakage in any of the barrels, as an act of good faith, we'll replace them, not even through the insurance. The market itself, of course, although it does appreciate as it ages, it is affected by market conditions. There's been a tremendous bourbon boom over the last 5-10 years or so. That doesn't look like stopping anytime soon. We're seeing more and more people drinking bourbon and enjoying it as their drink of choice.
So that being the case, with all those bottles behind you, if you were going to have a drink of choice, what would it be for you?
I mean, I love Pappy Van Winkle, which is
there it is.
I really enjoy Bardstown. So I guess it's because we're talking about it all day, and we're so enamored with the business itself that, even the bourbon tastes better.
Very good. Jeremy, where do people find you if they want to invest in some bourbon?
Yeah, they can come to CaskX.com.
That's Jeremy Kasler from CaskX. Thank you so much for taking the time. We appreciate it.
Lovely. Thank you for having me.
Watch the full interview with Jeremy Kasler of CaskX exclusively on our YouTube channel. Find the link in the episode description and learn how you can invest in barrels of bourbon by visiting CaskX.com. That's CaskX.com. Growing your wealth for retirement begins with some basic assumptions, but many of us don't know what's true or false. Don't base your entire financial future on misconceptions that are largely considered to be facts. Learn some truths about investing, Social Security, Medicare, and health savings accounts this week on YMYW TV, as Joe and Big Al talk financial fact versus fiction, and the truth may shock you. Click or tap the link in the episode description to watch YMYW TV, to download the Retirement Readiness Guide for free, and to share the show and the free resources with anyone you know who would enjoy some laughter with their financial education.
What's your favorite kind of bourbon?
I'm not really a bourbon guy.
No, you don't ever. Not
I
what?
wouldn't. I mean, I used to drink Jack Daniels in college. I tried it in
Didn't
my
everybody?
Yes, I tried it in my 40s. I go, how did I ever drink this? But I will say I did go to a brand new whiskey distillery in Chicago when I was there a couple of years ago, and I really did kind of enjoy it. But I couldn't tell you what I enjoyed. I just, no, that's good. That's not, whatever.
You've never had like an old fashioned?
No.
No.
Yeah. I'm more of a beer and wine guy.
Okay.
Joe, what's your favorite bourbon or whiskey?
Pappy Van Winkle.
Oh, there you go. That's why you
The
noticed
really
it.
expensive one.
I had.
You just had some?
I drank some of that bottle that he had behind him for Christmas.
Oh, okay.
Yes. It's very good.
Yeah.
It's very smooth.
Yeah. Okay.
Can you tell
very
the
expensive.
difference between that
Okay.
and something else?
What's that?
Can you tell the difference between the flavor of the Pappy Van Winkle compared to some of the others?
Oh,
Can you
yeah.
be like, oh, yes, this is definitely Pappy?
No, I could never recognize it like a
At a
test.
blind test.
I would be like, wow, this is pretty smooth, where this is pretty smoky, or this is pretty,
Yeah.
this is burning my throat. Right. But no, I'm not, I've had it twice in my life.
Oh, okay.
But it was good.
How about scotch? You like scotch?
Nope.
No.
No, not a big Scotch guy.
Really? Because it's about the same.
No. I guess I would drink it if someone
was put in front of you.
if so, yeah, you're at a dinner or something like that, and they didn't have any Coors Lights.
I went to a Scotch tasting in Edinburgh when I was there in Scotland, and I actually didn't care for that either.
Yeah, I would not go to a Scotch tasting or
You could taste the different. There were different tastes from different regions, so I did pick up on that, but it's not something I would just do normally.
No. I don't taste. I drink.
You don't care about taste, do you? Got it. Okay.
We got Mike from Colorado goes, hello, Joe. All right. Big Al, Andy. I've been a mutual fund investor for quite a while. Recently, I'm reading that ETFs may be better than mutual funds as they produce less capital gains and have other tax benefits. Vanguard and other companies have both ETFs and mutual funds that seem to have identical goals and holdings. Could you do a deep dive into the benefits and differences between ETFs and mutual funds? A deep dive.
Okay.
How deep you want us to go here, Mike?
Whole show.
Sounds like pretty deep.
I'm gonna probably give 3 differences.
Okay. All right. Go for it.
All right. So mutual funds, they're sold at net asset value versus an ETF that is sold like a stock.
Like
So
a security.
If you want to buy a stock right in the market, you
Right.
buy a mutual fund. You purchase it at the close of business.
Right.
The tax efficiencies of it, yeah, I agree with that. ETFs, it's again, but I think index funds. So if I'm looking at an ETF, it's basically you're buying an index fund within that exchange traded fund. If I have an actively managed fund, those aren't necessarily tax efficient because there's buying and selling as the mutual fund manager is changing the allocation within the stocks or bonds, whatever that they're doing, whatever strategy that they have inside the fund. Where an exchange traded fund is going to buy all of the stocks within that exchange, and they're going to hold on to those stocks until there's a reconstitution if a stock comes out or into the overall index. So that's why they're a little bit more tax efficient. But if you buy an S&P 500 mutual fund versus an S&P 500 exchange traded fund, really the major difference is that you could do some other things on the ETF, like you could put some, hedging on it or something like that because it trades like a security.
Right. Right. And I guess trading as a security, what that means is the price changes over the course of the day. Where a mutual fund, the price stays fixed until the end of the day. So that's the price you get, whatever it is at the end of the day. I think maybe a more important distinction is a passive fund versus an active fund. And I think most mutual funds used to be active, meaning a manager, investment managers trying to time the market and beat the market by buying and selling. And that causes a lot of capital gains that show up on your 1099 at year end because you are responsible for the gains and losses of that portfolio. And a passive fund doesn't do that. It just buys and holds in general. Now, a lot of mutual funds are now passive, particularly the index funds, and some ETFs are now active. So I think that's a more important distinction is a passive fund that just holds the market is going to be much more tax efficient and cheaper, by the way, because you don't have managers trying to figure out and time the market. So I would think about it that way. If you have an identical index fund versus an ETF, to me, there's not a lot of difference. I would probably favor the ETF, but I can't say that there's much difference, in my opinion.
Totally agree. What do we got? We got Lauren from Florida. Would love if you could do a show on how you approach the fixed income portion of the portfolio. Oh, we got the theme here going, Andy? Is that what
It's investing. Yeah. And I want to know how much of your portfolio should be in alternative assets like Pappy.
Okay. I'm trying to help my mother who just retired with the fixed income portion of her investments. And there's so many options. It's not clear what the best path is. Individual bonds, bond funds, tips, treasury, CDs, muni bonds, corporate bonds, Jenny Mae, short term, intermediate term, bubblegum shrimp.
Okay.
Gumbo shrimp.
What do you think? What?
Yes, there are a lot of options, and they're all good options. What I would do, in most cases, go into a low-cost bond fund.
Yeah, I agree with that.
So,
or a muni bond if taxes are a problem.
Yes. you go into individual bonds, it's a lot of work, and there's a lot of expertise, I think, that you need to build an individual bond ladder. If you're looking to ladder bonds and get income from the coupons, and tips are fine, but you can buy tips through a mutual fund or an ETF.
Yeah, tips can be more risky than you think, though. I mean,
true.
Yeah, they go up and down more.
Yeah, it's a treasury, but it's protected with inflation. CD ladders, right? But that's a lot of work, and it's all ordinary income. So is it in a retirement account? Is it not in a retirement account? Corporate bonds are great. You get a little bit higher yield, but you have more risk when you put money to corporate bonds. If you think about a bond, I guess maybe, Lauren, what a bond is a loan. So you're lending your money, let's say, to a corporation. You're going to give them cash, and in return for that money that they're using to build better infrastructure or hire better people on their staff, or whatever the case they need the money for, they're going to give you an interest rate. They're going to pay you 3%, 5%, 8%, whatever that is. And then at the end of the term of the loan, let's say it's 3 or 5 or 10 years, you get your money back. And then so you can take your money and invest in another corporation, or you can invest in a municipality, or you can invest in the government treasury. So, or you could give it to a bank, and they can lend it out, and they're going to give you a fixed rate such as a CD. So just understanding maybe what the investment is can maybe help narrow in of what is the appropriate strategy or product. But I think in most cases, just buy a mutual fund or ETF that's maybe short term in nature, just to stay away from risk.
Yeah, I 100% agree. I like the bond funds. I like muni bond funds if you are in a high tax bracket. And I don't mind CDs. I don't know that you need to go to a huge CD ladder strategy. I mean, just having a CD or two with different maturities. Now that interest rates are decent for CDs, but yeah, most people just use bond funds. It's much simpler.
Did you know that less than half of Americans have a solid understanding of basic investing terms and concepts? It's pretty tough to grow your wealth if you don't even know what tools and strategies are available, much less know how to use them to develop a long-term financial plan. Our free Investing Basics Guide will give you a beginner's overview of asset classes, from cash to fixed income, equities to commodities. Why does a basic 60-40 portfolio generally outperform the average DIY investor? Learn more about how mutual funds and ETFs are different, or stocks and bonds for that matter. What kind of returns do they get, and how much should you have of each? Find out. Click or tap the link in the episode description to download the Investing Basics Guide for free. Then try our financial blueprint tool for free too. Input your financial details like cash flow, assets, and what you expect to spend in retirement, and it'll output a detailed report with 3 scenarios that'll give you a clearer picture of where you stand on the path to retirement. Find the links for both the Financial Blueprint and the Investing Basics Guide in the episode description. Both free, both courtesy of Your Money, Your Wealth, and Pure Financial Advisors.
All right, let's go to DJ from Missouri. Hey, Andy, Big Al, Joe. I know that you hear it a lot, but I love your podcast. Don't ever retire, any of you. Oh, Big Al.
I have to stay.
Yeah, you're knocking on retirement
According
door.
to DJ.
I listen to you whenever I am when the new episode drops. What? I listen to you whenever I am when the episode drops. Wherever I am. Oh, just when it drops.
I'm there.
I'm stopping everything.
She stops and she listens.
I'm taking a shower. I'm turning it on.
Turning it on. All right. I don't drive anything fancy, and I rarely drink, but I share Big Al's love for all things outdoors.
Ooh.
All things outdoors. Big Al.
That is me.
Here is my question. Can a balanced fund be a solid way to asset allocate for my traditional IRA during the decumulation phase? Some say that in the decumulation phase, the 60-40 balanced fund for traditional IRA, not talking brokerage account, isn't the best choice, since one should be able to control what ETFs mutual funds they sell. In other words, one might choose to sell only a portion of the underlying funds and not some from all the funds if the stocks are down, for example. But the idea of having a fixed allocation that balanced the risk and return of stocks and bonds suited to one's overall financial plan and risk tolerance with regular rebalancing seems like a lot of sense to me. All right. When people sell off only a portion of their ETFs mutual funds, they're likely to get their asset allocation out of whack while waiting for the market to rebound. That changes the risk level. All right. If you do suggest that it is better to have individual funds in each asset class in a traditional IRA, how long do you let your asset allocation stay out of whack? Let's say greater than 5% off, for example. If you are selling individual ETFs, mutual funds, or in the long run, or is it just fine maintaining the 60/40 globally diversified ETF in one's traditional IRA? Thanks for all your thoughts, DJ. Interesting question.
Yeah.
So DJ's talking about maybe, all right, there's maybe a fund of funds or a target date fund or
just a balanced fund, like traditional balanced fund that has stocks and bonds.
It's like, all right, well, the portfolio managers managing the stocks and
They'll
bonds.
take care of it for me. Yeah.
Do that. Or does it make sense to say, I'm going to buy 60% of a stock fund and 40% of a bond fund?
Yeah, that way I can decide which to sell at the appropriate time.
I like the latter.
Me too. A little more work though.
It is a lot more work.
But you just have to know what your balances are. But I think a way to think about this is when you have, say, 2 or 3 funds, it's just when you need cash, you sell the one that's too high. And you always, stay in balance. Or maybe if they're exactly the right allocation, you sell 60% of stocks and 40% of bonds if that's your allocation. Very simple. It's just one extra step. But see, that way, if the stock market has a big correction, you don't want to be selling your stocks, you sell out of your bonds. If you're in a balanced fund, you're going to naturally be selling some stocks because they're included in that fund. So,
right. When the markets are fine, it's a totally great strategy. It's great. They're rebalancing. All right, it's going to get back into whack, using your words. But when it gets challenging, DJs, that, all right, now you're retired and you have this balanced fund and you're taking a certain percentage out each year, and then the market tanks. You drop 20, 30% that year, and you still need your income from the overall fund. It gets very difficult to get caught back up because they're basically selling the share, and it could be pro rata depending on what the distribution strategy is of the fund. But most likely you're selling stocks, and that's the last thing you want to be selling is stocks. You would much rather sell bonds or cash or another asset class.
yeah, and I think you can do this with 2 mutual fund or 2 index funds, maybe 3 if you want to get some international. So maybe think about it as like a total U.S. stock market fund, maybe a total U.S. bond fund, and if you want to add a little international, have some of it be an total international fund, and just whatever gets out of balance whichever one has too much in it, that's the one you sell to take care of your cash flow needs for that month or that quarter or that year, however often you take your distributions.
Yep. All right. Let's go. Hello, Joe and Al. I've been telling anyone who will listen to watch your TV show or listen to all your podcasts since 2019.
Wow.
Hell of a trooper there.
Yeah, I'll say.
I received great advice from you regarding real estate and estate planning. You even picked one of my questions to air on your podcast. I believe you both had fun bantering back and forth with each other about my son-in-law situation. I enjoyed it at any rate. What, we'd make fun of her son-in-law, you think?
Well, it has
You wouldn't do that.
It's a different show.
Yeah.
Probably wasn't us. But she's got another question here.
Okay.
I'm retired and have some extra funds I'm willing to gamble with.
Okay.
Gamble. In the 40s. Okay. 1940s?
Yeah.
Yes.
All right.
1940s. That's what that would mean.
My aunt bought AT&T stock, and fortunately, my uncle inherited.
Okay.
He sold it in the late 90s for a lot. I'm very interested in companies who supply the factory data centers being built all over the U.S. for AI. When I decide on which stock to buy, I just want to let it ride for about 10 years. All right. Here's my question. Since I'm ignorant in stock buying, should I hire a broker for my one-time roulette purchase or just open a brokerage account myself online with a well-known company? All right. Sincerely, TYIA. What does that mean?
Thank you in advance.
Oh, thank you in
Yeah.
advance.
Very good.
All right. Karen.
Karen.
Okay, Karen.
Sincerely Karen.
All right.
Okay.
No, just go to a discount brokerage and buy it online.
Yeah, that's easy.
You can go to Schwab, Fidelity, Vanguard, wherever.
Yeah, and pick any one of those. Yep. I totally agree with that. And as far as the strategy,
A broker is not going to take your call.
No, I got $10,000.
Hey, I mean, even if it's $100,000, I want to buy a single stock.
Yeah, they're not going to make any money.
Yeah, they'll be like, okay, great.
Here you go.
Hey, thanks,
here's
Karen.
the number to Schwab.
Yeah, here's a 1-800 number.
As far as the strategy, you know what? AT&T was a really good one. Apple was a really good one. There's been numerous ones. You just have to pick the right one. See, that's the hard part here. You have to pick the right one.
Well, at least she's calling it right. She's saying it's gambling.
It's gambling, and that's exactly what it is. Now, when it comes to AI, I agree. This is an industry that probably has a lot of potential. So I can see this being a good place to be. But will you pick the right AI company? That's hard. That's tough, right? So maybe you do, maybe you don't. You know, as single stock has the same expected return as the market. It's just a single stock could have a much wider range of returns.
Yep.
Could be great, or you could lose all your money. So just be aware of that when you do that. You use the word gambling, and I agree. That's kind of what it is.
Oh, Aaron, you killed it. You pushed the camera button 3 times today. Sorry to keep you up from your nap. Andy, wonderful job. Thanks for getting Mr.
Kasler from CaskX.
Yeah,
Jeremy
okay.
Kasler.
Talking whiskey, talking bourbon.
Yeah.
You gonna invest in bourbon?
No.
You might drink it. That's the problem.
Yeah, that's the problem.
Yeah, you would.
He's like, yeah, you might need a lot of friends. I was like, I don't know.
I think you got just family right there.
Yeah,
That would take care of
yeah.
it.
My mother, Ruthie, she's back in town. She's in town for like a month and a half.
All right.
I just probably need to get a barrel for her. All right, very good. Thank you all for listening. Keep the questions coming in. Appreciate the listenership. Without all of you, we would not have a phone. I was going to say, but not have a show.
Not have a show.
Yeah.
The show wouldn't be a show without the listeners and the viewers.
Yeah, well, I'm sure they listen to it on their phones.
Sometimes, yeah.
Except for that one couple that was listening to it at the dinner table.
It happens.
All right, we'll see you next week. Joe Scott, your money, your wealth.
Bye.
Next week on YMYW, Joe and Big Al spitball for Nancy in Washington State, Brian in Naperville, Illinois, Joy and her brother, the skipper in California, and they take a voice message from Mike in Colorado. Click or tap Ask Joe and Big Al in the episode description to get your own retirement spitball analysis. But to really make the most of your money and your wealth in retirement, you definitely need more than a spitball. Schedule a free financial assessment with the experienced professionals on Joe and Big Al's team at Pure. It is free, and they'll go deep to help you craft a financial plan that's especially customized to meet your tolerance for risk, your needs, and your goals in retirement. Click or tap the free assessment link in the episode description or call 888-994-6257 to book yours. You can meet online or in person. Pure Financial Advisors has 10 locations around the country now, with more on the way. Your Money, Your Wealth is presented by Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.